Hey guys, this is Sharat, host of REsimpli Podcast. Super excited to have a great guest on this REsimpli Podcast, Axel Ragnarsson. Hey Axel, how are you doing, man?
I'm doing well. How about yourself?
Doing really good, man. Thank you so much for being on the show, man. I'm super excited to be talking to you. Tell us a little bit about yourself, who you are, where you're joining in from, and what kind of investing do you do?
I live in Boston, Massachusetts, originally from New Hampshire. So, I've lived in New England my whole life. Got into the real estate business back in 2016. Was a junior in college, was doing a couple different things to make a buck at that time. Always been pretty entrepreneurial, but at the time I was buying and selling cars. I was flipping cars. And I think I saw an Instagram ad or I watched an episode on HGTV of like flip or flop or something like that. And I said, you know what, I want to go and try and flip houses. Let's make that kind of the next objective from an entrepreneurial standpoint. And at the time started learning all I could about how to flip houses, how to find deals, how to talk to sellers. As I was trying to look for single family house flips, and as I was learning about real estate, I stumbled upon multifamily real estate at the time, which that spoke to me, I think, a little bit more than the construction heavy nature of buying and selling single family homes. And I really like the idea of you can go buy a multifamily property or a rental property, fix it up and put a tenant in there and they start to pay you every month and you can start building passive income. So at the time I adjusted my strategy, but I still had a focus on going direct to seller to find deals and started calling and mailing and doing all of that to owners of 2 to 10 unit properties. And I found a couple of individuals that would extend me some private money financing to go out and buy them. And that was really how I got into the business. And to fast forward to the first 3-4 years I was in the business, really from 2016 to 2020, it was just me buying small multifamily properties with private debt, adding value, creating value, refinancing out of private money and into commercial debt and just growing the portfolio that way. So first few years in the business, bought about 70, 80 units that I personally owned. 2020 came around into 2021 and I had a moment of reflection where I was like, do I really want to go out there and just continue buying rentals, 6, 8 units at a time? Or do I want to try and scale a business and actually more intentionally build a business? And that's really what I ended up wanting to do was let's go out there, let's find bigger deals, let's raise some money to go and capitalize these larger deals. Maybe we'll start looking at some other markets as well. And that's where we really shifted the business into being more of a capital raising business. So from 2021 to now, just 2.5, 3 years or so, we've bought a few hundred units. We've raised a lot of LP capital from passive investors. I've still done a handful of deals myself on the side, just that I personally own and that I personally invest in. But we've really turned the business into more of a syndication type of business where we're going out there syndicating capital and buying small to mid-sized multifamily projects throughout Southern New Hampshire and other markets as well. We've done some deals down in Florida as well. And along the way, we started a property management company, brought our management in-house. We started offering third-party management services to other people in New Hampshire as well, and did some other stuff like starting a podcast and starting to build a personal brand as well. But really now the business is we go out there and we buy small to mid-sized multifamily, which I define as really 10 to 80 unit deals. Smaller side, I buy them. If they get a little bit larger, we go out there and raise capital and continuing to just grow the portfolio and bring more investors into our sphere. And that's currently what the business looks like today.
That's fantastic, man. So you started in real estate watching HGTV, Flip or Flop, or some flipping show. And then once you started looking more into it, instead of doing single family, you just started doing multifamily. Have you done any single family deals?
I bought a couple of houses to flip. I did a couple condos. I did a single family that we converted into a duplex. But what I realized really quickly was my skill set is in the finding the deals and the putting together the dough. Deals and money was where my skill set was. Operationally speaking, construction management, all of that was not necessarily where I would define my skill set to be. And over the years, I've gotten good at it. Like we have a great team now. We operate really well from a multifamily standpoint. But, when I was like getting into the business, I just didn't enjoy that part of the business. And that's insanely critical. Design, construction, controlling your costs, building a product that an end buyer, a homeowner would want. That just wasn't for me. So I did a couple of deals. I broke even on 2 and lost a ton of money on one very early in the business that I actually had to sell a bunch of rentals to just get out of that other deal. And I was like, you know what, I'm good. Like that's not the
Yeah.
lane that I want to play in. My skill set's in finding and adding value to multifamily assets, and
So
that's where I shifted my
no, man,
focus.
that's incredible. I'm really curious. So you started out buying multifamily. Did you have any fear factor, like not, just starting out big and not starting out with like smaller properties? I mean, that's what vast majority of investors do. Is eventually a lot of investors want to go into multifamily if they're doing buy and hold. But you just started out with that. How did you? I mean, did you have any fear? And if you did, how did you deal with that?
Yeah, I don't really think I had a lot of fear, to be honest. I think the proposition, and I will clarify too, like a lot of the first deals I did were smaller multifamily. So the first deal I did was a 3 unit. Second one I did was a duplex. Third deal was 6 units, right? That was kind of the jump, right? Was that third deal outside of the couple of house flips I did along the way. And I I got to tell you, the proposition of buying whether it was a small multifamily 2 to 4 units or commercial 5 plus was significantly less because it wasn't so dependent on my ability to do a great job from a construction management standpoint. Buying an income producing property just is a lot more forgiving in a lot of ways because outside of doing massive exterior work, like your in unit renovations are much more streamlined and simplified. Like you're doing some LVP flooring, you're putting some paint in, you're doing kind of contractor grade cabinets if you're doing a kitchen. And the first few deals I bought didn't require significant renovations within the units. I was just going direct to seller and securing great pricing on the buy side. And that was really where I was creating the value, was just buying at the right price versus doing a house flip where I'm like, okay, I got to knock down a wall. I got to get, I got to manage a GC. It's a much larger renovation scope. Maybe you're spending 10, 15K in an apartment. You're doing a house flip, a 3 bed, 2 bath. You're spending 50 grand because you're doing the kitchen and you're maybe changing the floor plan so that it's more functional. There's a lot more execution risk there. That's how I thought about it. Like the margin for error was a lot lower. So for me, I was more afraid of doing anything on the transactional house flipping side than I was getting into multifamily property. I thought that was actually a lot easier.
Yeah, man, that makes sense. I mean, no, it's tons of credit to you, but Mike, I want to. I'm curious. Like a lot of investors, I'm sure you've noticed, start out with wholesaling. Like that's the way they start, and then they go into flipping, then buy and hold. Was your goal always to just jump right into buy and hold, and then just like start with the end goal in mind, and just cut out wholesaling and flipping?
Yeah, it really was early on. My goal is always I want to grow my pass. I want to build passive income. I want checks coming in. I want some consistency of income. And it's funny, if I were to go back and do it again, I probably would have wholesaled more deals because it would have allowed me to stack cash and resources a little bit more quickly early on versus trying to buy multifamilies and scrape by with cash flow until I got to the refinance and got the chunk of equity I put down back out. So it took me a little bit longer to grow in the beginning as a result of that. But frankly, I think the reason I was buying everything was because I had the financing lined up. Like I did a very good job of networking with a lot of different private money lenders that lent me very large percentages of purchase prices on the deals I was buying. So like I knew that I could buy all the good deals I found. So there was no roadblock as it related to actually closing the deal, which I think a lot of people face on the wholesaling side. They start out, they don't necessarily either have the money themselves or the source of money, whether it's a partner or whether it's a private money lender. So they just resort to wholesaling and they want to pick up those fees. But early on, I was like, I want to build a portfolio. I want to get to 15, 20 units so that I'm pulling in a few grand a month. And, my goal is like, I just want to pay for my rent and I want to pay for my expenses. And then I'll take a step back and reevaluate what I want to do. But that was always my goal initially, was to get to that point very quickly. And I had everything else lined up to actually go out and buy the properties themselves. So I felt like that was a better path for me. But if I were to do it again, I probably would have wholesaled and been a little bit more transactional on deals here and there to just get more money coming back in the door. It would have made it a little bit less stressful as I was growing the portfolio initially.
Yeah, no, absolutely, man.
So I was running my cash reserves down every time.
How did you go about building a list of private lenders, or have financing lined up? That's always I think one of the biggest challenges newer investors have is the lack of funds, and you had that, and that's why you started out with multifamily. How did you make that happen?
I just went to a ton of meetups. I think private money lenders go to meetups. It sounds so simplified, but that's really the best place to go. You go to private money, or no, excuse me, not private money. You go to real estate meetups and you just ask, you stand up in front of the whole group saying, I'm an investor that buys this. I've done a handful of deals. I have the ability to execute. Just looking for hard money lenders, private money lenders. And you'll start to meet people. You might meet people that aren't going to offer you great terms. Maybe they're only going to offer you 80% of purchase price and they're going to charge you 13% interest or something like that. But you just continue putting yourself out there and voicing what you're looking for, and you'll start to find folks. Pro tip, and this is kind of a real tactical one for everybody listening. When you think about who is actually speaking with private money lenders all the time, it's the people conducting the closings, right? So closing attorneys and title companies, they know all the private money lenders. If you find the title companies or the closing attorneys in your marketplace that are very active, that are transacting a large volume of business, that are just sitting at the closing table between buyer, seller, and they know who the lender is because they're either putting the loan docs together or they just see it on the HUD statement, closing statement, they're going to be great sources from a referral standpoint in terms of, hey, Mr. Attorney who's handling, 20 closings a week, who are you seeing that does private money lending in this area? Would you be comfortable making an intro? And they're typically going to be comfortable making that intro because they're not vouching for you as a borrower. They're just going to go out to that lender and say, hey, I got a borrower who's wondering if he's looking to meet more private money lenders. Maybe it would make sense for you to chat. And that's how I found a couple of private money lenders as well, was just getting referrals from title companies and closing attorneys. And it's just a sheer volume of effort. Always asking for referrals, going to the meetups, asking the A players, the brokers, the title companies, the mortgage brokers, the property managers, the whoever, for referrals, and eventually you start to build out a roster of lenders.
For the first couple of deals, did you use your own money or you had private money from day one or from deal one?
Yeah, I was forced to go the private money route. Just the first deal I did, I was 21. I had no credit. I had money, right? I think that's an important distinction. I didn't get into real estate with like $0. I was fortunate enough to do very well in my previous business, my side hustle, I guess, of flipping cars. So I had 35K at the time, and I found a deal that was 200 grand. It was a 3-unit deal. I met somebody through an internship I had. It was actually one of the managers at this investment group that I was interning at in college, who did private money lending on the side, and I just convinced him to lend me the dough. 90% loan to value. No construction financing or anything like that. It was just 90% of the purchase price. I said, hey, this is worth 250. I have it under contract at 200. Get an appraisal to validate that. If the appraisal validates that it's worth 250, if you can give me 90% of the 210, which was 180, you still have plenty of equity as a lender here, between loan balance and property value. And he's like, yep, sounds good. Charged me 12%. So it's not like it was cheap money. It was, it was basically hard money rates, but I was in and out of that deal in a year. And that's what I did on the first, a handful of properties. Was I started with this 30 grand or so. And that would basically that was put all of that down to buy that first one. And I had a couple of water heaters that broke, and I just put it on like credit cards with like 30-day advances and stuff like that. Don't do that. Not smart. But at the time, that was really the only option I had. But I just, recycled that capital into the first deal, into the second deal, I should say, into the third, the fourth, the fifth. And over time, I built relationships with private money lenders to where they would just finance 100% of a purchase price. That's rare. That takes relationship development with a lender. But, the way that I sold that was in a deal where, let's say I was buying a property for 500 grand. I need to invest 75 into it, and then it's worth 750 or something like that. I was always coming out of pocket for construction. So I was still bringing skin to the game. So it's not like I was truly into it for $0. I was like, if you finance the full purchase price, I'll go in there and actually finance all the construction and the CapEx. And I was paying healthy interest rates, 10, 11, 12%, those first dozens of deals, right? It's not like I was getting, really cheap money. So it made sense for both lender and myself over time. And that's really how I built the business initially, the first few years.
Yeah, and once I've noticed, I'm sure you have very similar experience. Once you do a couple of deals with private money lenders and you actually return them the money, they make money, then they want to borrow, but then they want to lend you more money. They have more money to lend, and then they talk to their friends and families, and then all of a sudden you have more money to use. Has that kind of been your experience?
No, 100%. Yeah, I would get referrals from some lenders to other folks, within their network. The dream situation for a private money lender is, if you put yourselves in their shoes, is they just want to work with like one or two people who are going to borrow all their money. They don't want to have to go through the process of finding new borrowers, vetting new borrowers, because that means they have to vet their experience. They need to be more diligent about vetting the deals that they're being brought. Do they have to explain their terms and their process, et cetera, et cetera? The dream situation for a lender is like, I just have these couple of investors or few investors that just come back to me a few times a year for lending. And it's like, I know exactly what types of projects they buy. I know Axel buys 5 to 20 unit multifamily properties in this little area. I know that he knows how to do that. I know that he knows how to define a good deal. I know that he's got the GCs and the contract, or the GCs, the vendors, the property management, all of that set up, and he's going to do a good job. And he knows how I like to lend, and he's familiar with my loan docs, and he's familiar with my terms. So when you think about it that way, like once you do a couple deals with one lender, they would just prefer to continue working with you. And then over time, you actually start to build negotiating power as a borrower, because they'd rather lend you money at 10% hypothetically in a couple of points versus this new investor that they have no relationship with at 11 and a quarter or something like that. It makes more sense for them to just go back and do more volume with the same person.
I agree. Yeah, I mean, at that point, their money is like, relatively speaking, safe with you. They know you, they trust you, so they're okay taking a little bit less return than to go after like a couple of extra points with someone they have no idea about. 100% agreement. Axel, can you walk us through what your typical deal looks like? Maybe one of the recent deals you've done. What does that look like? Numbers on it. You don't have to, give address or anything, but yeah, it would be great if you can walk us through, what's your buying criteria? What makes a good property? What doesn't make a good deal?
Absolutely. Yeah. So we have a pretty wide criteria because I'm still personally open to buying smaller pieces of real estate, just myself, just me. We raise money to buy the vast majority of the deals that we source now, but I'll still buy stuff on my own. So I define our buying criteria as 5 to 80 unit buildings, which is very wide, right? And this is in southern New Hampshire and northern Rhode Island, basically an hour north of Boston, an hour south of Boston. And then we also buy real estate in Florida, but we've cooled on Florida in the last year just for some challenges from an insurance standpoint down there. In the short term, very focused in New England, and specifically focused in New Hampshire, where we own our property management company. So really our sweet spot are deals that are 20 to 80 units in size. Most of what we do is 20 to 40, 20 to 50 units. We love to source opportunities direct to seller. We're REsimpli users. We do a lot of direct to seller marketing, both mail, outbound calling, outbound texting. I'm also very, very intentional about building our brand awareness in the marketplace so that we're brought deals by, brokers off market. We're brought deals by other service providers like insurance brokers, attorneys, PMs, et cetera. Other investors that may stumble across a deal that doesn't work for them, they can refer it to us and make a couple bucks. And that's really where we thrive. And as an example, we closed 2 buildings that were sourced from one seller. We bought these in July of 2023, thinking that this will just be a good example of what we're talking about here. Not technically direct to seller, despite that being the vast majority of what we do is direct to seller. But this was a situation where there was a residential agent who normally sells single family homes, but was on our email list and knew us really well. And brought us a 23 unit deal and a 45 unit deal from an owner that was just like a personal friend of hers. She's not a multifamily broker. She was not marketing it in the correct way. And she just kind of brought it to us saying like, hey, I just have a, family friend that wants to sell these buildings. Is this something you'd be interested in? And, dove on those. Those are 2 separate deals. But for example, the 23 unit deal is kind of the exact story of what we like to buy. I mean, both were, but I'll talk about the 23 unit one, where we had 17 studios, 3 2-beds, 3 3-bedroom units. Building had a little bit of deferred maintenance, needed a roof, needed a new parking lot. We needed to paint the siding. We had to go through paint common areas, do new flooring in common areas, renovate, the units, paint, flooring, kind of cosmetic upgrades at 12 to 18 grand a unit, depending on whether it was a studio or a larger 3-bed. And it was owned by someone who had owned it for, I think they bought it in like 2015. So they'd owned it for 7-8 years. Their management company was terrible, just was not doing a good job at all. The units were severely under rented. Like studios that were renting at $600-$700 a month, that market is $1,200-$1,300 a month, conservatively. Oh, wow. And that's where we've been leasing. And 2 beds at $1,000 that should have been $1,700, and just bought it for cheap money back then, and just didn't really keep up to date with how it was doing, and just kind of let it go. And then we're like, all right, I want to retire and get rid of this. I don't even want to deal with it anymore. Let's just sell it. Called up their family friend who was not the right individual to sell that building, and then it got to us, right? And from an economic standpoint, We paid, we always talk in per unit prices to make things easier with multifamily. We paid roughly 104 a unit for that building. We're into it for roughly 118, 120 a unit with transactional costs. And that's a building that if we went and got it appraised, we've only owned it for 7 months now. It would appraise in the mid 140s to 150 a unit, right? We could pull all the equity we have in that deal out. We've basically created $20,000 to $30,000 per unit in value, 20-30% plus above our basis in that, which means we can pull out all of our capital and our investor capital in that deal when we do decide to refinance it. And those are the deals we love. Those are like our sweet spot. And that happened to be an example of one we were brought by an individual, but it was still very much an off-market deal. And we find these deals direct to seller. And that's why we spend a lot of time going direct to sellers, because you can still find those types of deals going directly to owner, these small to mid-sized multifamily types of deals.
So is there a certain percentage of after repair value that you have like a cutoff that, let's say if talking about in per unit cost, let's say if the after repair value is 100,000, like you would not go over, in residential real estate, people use 70% formula, right? They want to go whatever the ARV is times 70% minus any repairs. Do you have something like that in multifamily that you use?
I think it's very similar conceptually speaking, right? We do the analysis the same way. We want to be into it. We're okay with being in a little bit more than 70%. If we're into it for 80% of the value, I think that's a very good deal for us. That's creating great returns for us, and then more specifically, our investors that are investing in that deal, to the point to where they're very happy with their returns. We're happy as sponsors of the deal in terms of creating value for both our investors, and then we're going to get into our split, above our preferred return, which is more like tactical kind of deal structure conversations. But to more specifically answer your question, if we're into it for 80%, that's a great outcome. That's typically where we're trying to underwrite. For example, if we're buying a property for $1 million, we're putting a couple $100,000 into it, and it's worth 1.5 when we're done, 1.5, 1.55, 1.6, that's a win for us. And the way we get there, very simple. It's very similar to how somebody's calculating the value from a comp standpoint in the single family world or the small 2 to 4 unit multifamily world. Our purchase price, our transaction costs, our projected renovation, that's going to be our all-in basis. We're going to go and take our stabilized net operating income, which is how we're going to value a multifamily property. What is this property going to be producing when we're done? And we take all the rents to market, and we take the rents to where they need to be. Maybe we're cutting some of the expenses and we're trying to reduce the expenses. All trickles down to what's the net operating income of the building? What's the cap rate in the marketplace? Now we have our stabilized value, and we can work backwards from there to figuring out what we're able to pay for that building. So very similar process. We're using a bigger Excel sheet, and it takes a little bit longer, but conceptually speaking, that's how we think about it, right? Similar approach. How
has the interest rate affected your business? Has it been a positive or negative impact on your business?
That's a great question. I think there's a little bit of nuance in that it hasn't necessarily affected what we do on the smaller components of our criteria too significantly. Like a 5, 6, 10 unit building. Oftentimes those are going to be owned by a mom and pop owner. Like, if they're selling, you still have the ability to negotiate a good deal. However, we're going to define that, where you're into it for 70, 80% of after repair value. And the interest rate market isn't necessarily going to affect your underwriting that significantly. Your cost of borrowing isn't going to be such a significant difference that it's like turning a deal into not a deal type of situation, right? Might affect the overall market in terms of what you think the property is going to be worth after, because cap rates might have gone up, but you still are able to negotiate quality deals there because there's typically some owner distress. They got a few tenants in the building that aren't paying, and they're just fed up. They're sick of managing it. They want to retire, what have you. And they're still a motivated seller, so you can still secure a good price on the smaller end of that spectrum. However, it's been much more of an effect on the larger side of our criteria. Call it 40 to 80 units, right? We're starting to get into $5 million plus in deal size, because those owners are very sophisticated. Like, those owners understand the landscape. They're probably operating their property fairly well. Rents are probably pretty close to market. They probably have a sense of what's going on in the market as well in general. Probably not going to be motivated, right, from a financial standpoint. They're probably just going to be selling because they want to sell and they want to capitalize on maybe some value they've created, or maybe they own it with a partner and the partner wants to sell and one doesn't, so they decide to sell it. But like, they still understand the marketplace. But those deals have been much trickier to pencil with high interest rates because those owners don't necessarily have the personal motivation or the lifestyle motivation, and they're anchored to pricing from 2021, 2022 when they've been getting appraisals as they refinance. The one situation we always see is somebody refied in 21 or 22 because rates were so low, and they had their appraisal done as they refinanced, and that's kind of anchoring their value of their property. And it was much higher
Right.
back then than it is today. So we've had a really hard time closing the gap between where sellers want to be and where we want to be as buyers on the larger deals. And that's probably where it's affected our business a little bit more. On the smaller stuff, it's like not too dissimilar from the house flipping game where people are selling personal motivation,
Right.
lifestyle motivation, and you can still negotiate a good deal if you're catching somebody at the right time. But it's made it harder to do the big deals for sure.
Right. But on the large multifamily or any 5 unit or above, you're not getting 30% fixed loans, right? You're getting loans that are adjusting every 5 to 7 years. Is that correct?
That is
So
correct. Yeah. So we typically work with local banks, local credit unions to finance our deals with commercial mortgages. 25%. Well, I should go the other way. 75% loan to cost is typically what we try to secure when we're buying a property. So 75% of purchase price, 75% of construction. And usually we have a fixed rate for 5, 7, or 10 years. Depending on how long you fix it for, we'll determine what that rate is. If you're fixing it for 10, it's going to be a little bit higher than if you're fixing it for 5 and letting it adjust for the last 5. Usually got a 10-year term. And then we usually still secure 30-year amortization periods with like the local banks we work with. But you're correct in that the term is going to be shorter, and then the rate's typically going to be a little bit higher than what you would see
right.
on a 30-year fixed rate loan on a smaller building.
Are you noticing people like not very sophisticated investors who took out loans maybe let's say 3 to 5 to 7 years ago, and now their interest rate is adjusting to a much higher interest rate, and they're like, "Oh shoot, we cannot afford this property." Are you noticing those sellers?
Yeah, I think parts of the country that's much more prevalent than other parts. In a market like Florida, yes, like without a doubt, where Florida became such a hot market with national interest from a buyer standpoint.
Right.
Like we were competing, I'm in Boston, right? Where we're competing with deals in Central Florida in the city of Lakeland, which is 100,000 people. It's not like Tampa or Orlando or Miami, like it's not a major city down there, but we were still competing with New York buyers and
Wow.
Boston buyers and California buyers and local Florida buyers. And those deals were so bid up and just hotly contested that a lot of buyers were forced to go the shorter term adjustable rate approach just because they needed to reduce their interest rate to get the deal done to make it pencil. And there's a lot of owners that are in tricky spots in markets that were hot, like, just the Southeast, Southwest US, Phoenix, the cities like the Phoenix,
Right.
Tampa's, Austin, Dallas. But conversely, in a market like New Hampshire, which we're competing with New Hampshire people and we're competing with Boston people. That's kind of really it. And there wasn't really ever the need to go insane from a debt structure standpoint to get deals done. That a lot of the people up there are actually doing just fine, right? And
Right.
there's almost no distress up there, comparatively speaking, to the Southeast, Southwest. And the other component too is, and this is like very tactical nitty gritty, so apologies if I get sidetracked, but there's less local banks and local community banks and local community credit unions that are lending in a market like Florida than the Northeast. The Northeast has one of the highest concentrations of local banks and local credit unions in the country because it's just the oldest part of the U.S. Like there's been banks here for 300 years. So there's an abundance of quality local debt with fixed rate options so that buyers never really had to go the floating rate direction. Whereas a lot of multifamily owners in the Sun Belt, the best option was typically the agency lenders, Fannie Mae, Freddie Mac, and working with their multifamily lending programs. Typically lower rates, typically longer amortization periods, better LTVs comparatively to the Northeast. So a lot of buyers were using those agency loan products. And if you use an agency loan and you fix your rate, you're facing incredibly prohibitive prepayment penalties where it's like extremely difficult to sell or refinance because your prepayment penalties for your loan are huge. And a lot of buyers that are buying value add don't want to be locked into that. So they go the floating rate route. So there's just a much higher percentage of individuals buying property in the Southeast, Southwest with floating rate debt, just because that's more of an abundant option versus the Northeast where we can work with a local bank, we can fix our rate, and we can negotiate away our prepayment penalties so we can have our cake and eat it too. So
Absolutely.
it's an interesting dynamic for those two specific geographical areas. And I gave you
No,
a
I
lot,
think
but I
it
think it
makes
really
sense.
depends
Yeah.
on where they're
No, I think it makes total
geographically
sense, man.
speaking.
I work with a local lender in my area also, and you have more flexibility working with a local lender than you have working with Chase or Wells Fargo's of the world. So 100% agree with you on that. So I have one question before we move on to the next segment of our podcast. So if there's a newbie investor, right? Someone's listening to this podcast and they're thinking, man, it sounds like multifamily, especially like, up to 20 units. It's very similar to residential property, right? You're running your numbers the same way. You're just playing at a bigger level, right? You just need to have money lined up, a little bit more money lined up, but then your return is going to be much higher, right? What would you tell that investor to take the leap?
Yeah, I think there's really a few specific things that you should try to avoid doing when you're getting into multifamily real estate. Like, let's say you've got experience buying single family rentals or wholesaling, flipping single family properties. You want to go out and buy a 10 unit, right? Your mail campaign has hit a guy that owns a 10 unit property, and you're trying to figure out, hey, is this something that I can handle? I think you need to just protect yourself. I think something that a lot of investors don't do when they get into multifamily is make it easy for themselves to buy the property and increase the likelihood that they don't get burned. And really, that happens in a few different ways. You just buy in a really bad neighborhood, like buying in a really bad neighborhood, which I'll define as like a very high crime area, an area with like a median income that's much less than that city or town's median income, is going to make everything just so much more challenging. And that's where you have the biggest disconnect between your spreadsheet math and then your reality math.
Right.
And that's really where an investor can find themselves in a tricky spot where it's like, okay, you underwrote your vacancy at 5%, but in this neighborhood, it's probably 10. And then even when you're not physically vacant, you're going to have 10% economic vacancy because 10% of your tenants aren't going to pay. And now your spreadsheet math is totally shot. So make it easy for yourself. Don't buy in like a really bad area. Buy in a C or a B area, median income kind of around the median income, not a crazy high crime, something that is going to align with your spreadsheet math most significantly. You don't want to buy anything that requires a massive amount of capex, of just renovations. Again, because that increases the variance of how the deal is going to go. Specifically, you should look for a property that only really requires in-unit renovations, that has a good roof, good bones, good siding, decent windows. Maybe you got to do a heating system here and there or something like that. Maybe you're repaving the driveway. But you want the majority of your dollars to be spent inside of the units when you're buying multifamily, because that's what drives rents, therefore driving net operating income, and therefore driving the value of the property. So it's a lot easier for you to really affect the value of the property when you're spending your capex dollars, your renovation dollars inside the units or on stuff that helps you rent the unit for more. So avoid really bad areas, avoid high capex spend type of properties. Worst thing you can do is combine those two mistakes on one deal, because that's really where you start to get into some trouble. And the third thing is put together your debt in a way that doesn't put you in a really tough spot. I got into this game by using a lot of private money, but I was doing so on very small buildings where I knew that I could get it to the after repair situation, stabilized situation within the first 6 months, within the first 9 months. And I was borrowing private money at 18-month notes, right? 18-month terms. So I had a buffer there. Typically would negotiate comes some kind of an extension option. I never would ever want to buy something with a shorter loan term than that. One of the worst situations you can be in is buying a multifamily. The business plan starts to take a little bit longer for you to implement. You have a 1-year note on it, and then you become a forced refinance or a forced seller in that year. That's where things start to get really stressful. So my recommendation would be the first deal you buy, just go to a local bank. If you don't have the 25% down required to do that, go find a partner. If you have a great deal, it should be easy to find another active investor in your marketplace that will partner on it with you. Maybe you bring half the capital, maybe they bring half, or they bring 75, you bring 25% of the required money. Maybe you make a little bit less on that first one because you don't own the whole thing, but that's okay, right? You're just trying to learn on that first deal, those first couple of deals. And then that sets you up for success on the next one, right? You start building your resume, you start to understand the process of multifamily ownership. You go through the underwriting process with the bank, you become more familiar with that part of the process. And you're just shortcutting the curve or short, removing the variables required to get into that first property, which is ultimately the goal. Is you just want to get into it. You just want to do one, which is where you learn everything. So I guess if I were to summarize, it's use the right debt. Don't use like hard money financing on a big multifamily deal where you're just going to be stressed out. I've seen more people get in trouble because they didn't use the right debt than really any other reason. And then second and third is just buying it in an area that's not terrible, and don't buy something that requires a ton of dough to turn the building around. Buy something where it's like, all right, we're going to go and spruce up the units when somebody moves out, and keep it to a simple business plan so that you're mitigating the chances that you get in your own way.
That's such a good advice. Just basically stick to fundamentals. Don't try to, just get into something that's way beyond your capacity. Just buy something in a decent neighborhood that doesn't need too much work. It doesn't have to be home run with your first deal. Just get your feet well. It doesn't have to be the best deal ever. Just buy something just to get into, just to get some experience. I 100% agree with that, man. Thank you so much for sharing that. Cool, man. Moving on to the next part of our podcast. What do you do for fun?
Oh, that's a good question. I live in New England, so I ski a lot in the winter and I golf a lot in the summer. I would say those are the outside activities. Outside of that, it sounds lame, but I just love what I do. I really love the game of real estate. I'm a crack addict, deal junkie, like the best of them. I love, I get the most juiced up when I'm chasing a deal. So for me, I just naturally work a decent amount as a result of that. But and then the stuff outside that I do that's adjacent to the core real estate business is stuff I enjoy as well. Stuff like hosting the podcast, which we just had you on there. Love hosting the podcast. I love hosting events like meetups as it relates to real estate. But if I'm going to give you a better answer, golf, skiing, and then I travel a lot. I try to get outside of the country a few times a year. I'm going to South America for a couple of weeks here in a month or so, Colombia, then down to Brazil, and I try to get out and do a trip like that a few times a year. So.
It's fantastic, man.
Maybe I need to find more hobbies. Long story short.
No, dude, you got a lot going on. Yeah, with buying a multifamily, running a multifamily business, skiing, golf, and travel. Yeah, I think you have your hands full. All right. What's the one book? It could be a business book or a personal book or one of each that has had the biggest impact in your life.
Oh, that's really good. I should read more, so I'm going to caveat that. I've probably read like 10 books. I got to read more books, but I think the one book specific to me, and I think it really helped me because of the time that I read it at, was the book Who Not How, Dan Sullivan, Ben Hardy. It's all about. It's fundamentally a book on delegation and bringing other people into your business, into your sphere to help you grow faster, and it has both personal applications just in your own life and then also business applications, right? It's not really about how you do something. It's about who can potentially do that for you. I've never had a partner in my business. I spent the first 5 years in this business with no employees, no partners, nothing like that, even on individual deals. I just did everything myself. And the reason that I got into real estate was I wanted to work for myself. And I kind of had a fear of bringing other people into my business, whether they were, salaried employees or contract employees or partners, even investors, right? And I read that book, I remember a few years ago, and it kind of just, for some reason, really unlocked something at the time with me where I was like, you're just simply not going to get where you want to go if you're just continuing to do everything yourself. And I've really done a 180 on that. And we use a lot of contracted VAs, contract employees. I, built a property management company around that time and started to build out that business and started to build out our own business to where I have a full-time acquisitions person now, an assistant. And that's really what also helped me to make the leap to raising capital from investors. You're going to need to bring in other people if you have a big objective, a big mission, a big goal. So for me, that book was really impactful, specifically because of when I read it, I think, as well.
Yeah, it's a great book, man. I don't know if it's an African saying or Chinese, or I don't know where it's from, but if you want to go fast, go alone. If you want to go far, go with others or something like that. Yeah, I've read that book. Fantastic book. All right, man. Last question. If you could spend a day with anyone, dead or alive, who would you want to spend the day with and why?
Oh, man. You got some great questions. These are really good. Spend the day with anyone, huh? Ooh, dead or alive. I'd love to just kick it with Matt Damon for a day.
Yeah.
Boston guy is my favorite actor. I'm a big movie guy, so that would be a lot of fun. Maybe that's the personal one that would be a cool hang. On the business side, if I were to really who do I want to talk to that probably has every answer from a real estate standpoint? Man, probably Barry Sternlicht, the guy that runs Starwood Capital Group. He's one of the most successful real estate investors of all time. I respect him immensely, both as a real estate guy and a business owner. A lot of what I've read and consumed from a real estate education standpoint is just his interviews, his conversations, articles that he's written over the years to his company investors. And a lot of the principles that he's applied to real estate investing are principles that I try to apply to what we do in our business. So I give you two, but he's probably the business answer. And then
great answers, man.
Matt Damon's my favorite actor, man. I want to chill with him.
Great answers. Yeah. All right, man. So anyone who's listening to this show, what's the best way for them to get in touch with you? If they want to connect with you, learn a little bit more about what you have going on, what's the best way?
So at Multifamily Wealth on Instagram is my Instagram account. I'm very active on there, constantly posting helpful content for folks who want to start, build, or scale their multifamily business. And then I host the Multifamily Wealth Podcast. I like to think it's one of the best multifamily podcasts out there. I mean, we're certainly one of the highest reviewed, both in number of reviews and then average reviews. And, if you just want to reach out to me over email, Axel, AXEL at aligned REP.com. So ALIGNED REP.com.
We'll put that in the show notes also, man. All right, Axel, thank you so much for being on the show, man. You shared tons and tons of great information. Makes me want to go out and buy some multifamily properties, just like scale up my game. So thank you for doing that and breaking it all down.
Love it. And I appreciate the invite. Thanks for having me.
Absolutely, man. Thanks.